Rough day in the markets today. Let's talk about it. So, hey guys, Jack here from 9 to 5, and I hope you had a good trading day. I didn't have a great trading day, and that's kind of what comes with the territory when you have a delta neutral portfolio. So, in this video, I'm going to cover what happened to my portfolio, as well as kind of show you the damage toll so far. Not many people are going to be willing to do this and show you when they had kind of a rough day, but why not, right? I mean, this is why we're here. And I'll also want to go into detail about how I made my decisions for adjusting my trade, and in that kind of talk through the process of defending a strangle trade, a delta neutral short strangle when it goes against you. So let's go ahead and dive into it. So looking at my overall portfolio, you can see here that yeah, I had a rough day, down 400 bucks, but the market was down by much more than that. And even though I was delta neutral, so large swings in the market like we had today, that should really tear up a portfolio. The damage wasn't really that bad, and as you can see here, looking at the portfolio curve, I'm still in that profit zone where my overall portfolio, even though you look at this, and pretty much every single security took a big loss or a big swing one way or the other. You can see here in this column, the overall portfolio is very resilient, and that's what I like about making those trades where as I defend, and you'll see that in a second, the portfolio can really drift with the market. It does take that originally very broad profit window and it starts to suck it in and bring it inside here, because whenever trades start to go against you, you don't move, as we'll talk in a second, but you don't move the side that's being tested, you bring the untested side in. And so what that does over time, your portfolio does start to squish in a little bit. But one thing I want to call out here is that even though this picture doesn't look the best, it looks kind of grim, the two standard deviation lines are over here and over here. There's still a lot of chart that's shown, and with being undefined risk trades, you know, there's combined, so there's 2.5% of the probability, that's a point, over here, and 2.5% of the probability over here. 95% lives within this range here, and you can see it's just the scale is a little bit strange. So what you want to do is really look at the point when you start to go negative is when the S&P is likely to be around $251 or up at $280. And right now it's still sitting pretty at 263. So we've got a significant range of profitability in our portfolio. That means there's nothing to fear. That's why I do what I do here. And additionally, even though the markets were kind of very interesting today, both in increased volatility as well as price movement, there was no question about what should I do? Should I buy? Should I sell? It was mechanical. So what I want to do is walk you through what I did with my Q's position. So as you can see, and I am going to try to zoom in here on this chart. As you can see here, my short strike was placed at, I think that was the 160, I should have my notes here, but where my short strike was, the security went beneath it during the trading day today, and that is my trigger. It may not be the perfect trigger. I know I've heard of other traders who use an actual specific delta value to determine when to make an adjustment or not, and that makes a lot of sense. But as busy traders like you and I are, we don't always have time to look at all the Greeks all the time, whereas pricing alerts, you can set that up through any number of ways to get text alerts and everything else. So I was able to get an alert when the Qs went below my strike price, and that told me to take action. So what I want to do is walk you through what I did. And if we go to my activity page, you will see that let's just go to today. Well, so the original trade was here. I got $504 for that trade, and it was a 164.179 strangle. And you can see the movement that I made today was to reduce that 79 strangle. I closed that guy out, and I opened up a 171 strangle. And that net activity yielded me $180 for the adjustment. So the two questions are, why did I adjust now? And secondly, how did I determine to adjust from 179 down to 171? Why didn't I choose 170 or 169, et cetera, et cetera? So let's get into that here. So why I adjusted was because if you look at the portfolio here and highlight into just the Qs, if we were to rewind in time, my delta value was getting significantly higher than what you saw here. And that is because the put, the short put, gives you positive delta. That means that you make money when the underlying security goes up, right? You guys follow me there? And the short call has negative delta, which means, you guessed it, it makes money when the security goes down. So when the security is moving in a direction or the other direction, the strengths of those deltas change. So as it's approaching this direction, this positive delta gets stronger and the negative delta gets weaker. And that makes intuitive sense, because if we were to go and place this trade today, let's say we want to go ahead and place a trade in the Qs. Remember, when we placed it originally, we placed it at the 30 delta, or right around the 30 delta. But if you were to come through and not having looked at it before, this is the 50 delta, and that's the negative 50 delta, and that's the positive 50 delta. So as the stock price changes, the deltas underlying each strike price move fluidly with it. So that's where you want to maintain, or I want to maintain, as neutral of a delta as possible, which means that as the strikes move further away from me, I need to bring them back into balance. And the two ways you could do that are to move this guy. If you were to move the short put, you could move it up. Don't do that, but you could move it up, and that would reduce it from a 57 delta to a 42 delta, which would bring you closer in line. Or you could take the short call and chase the security. And as you can see, you go from a 23 delta here up to a 35 delta if you were to make that move, and you can do the simple math of what the net impact should be. So for example, let's take where this position is. You can see that I have a negative 57 delta and a positive 23 delta. Now here's where it gets a little bit tricky, and you have to kind of use your noggin here. We are short these securities. So when you're looking at this, you should really consider it as a positive, because you're selling a negative delta, which makes the delta positive, and you are selling a positive delta, which makes the delta negative. Hope that makes sense. That's some algebra there for us. So what we can do here is we can say 57 minus 23. I will pull up my calculator for assistance. Gives us a positive 34 delta. So let's confirm that logic. And where are we? Positive 34 delta. So you can see how it works, how you can kind of anticipate with what the net effect of your roll is going to be. Additionally, if you're using the web platform, it does allow you to kind of see that before you make the trade. So just for fun, let's say I were to roll it even further up. If you click this arrow here, you can see what the net impact of that delta would be if you made that trade. And for example, in that, so you can see the trade side, the position side, and the overall portfolio side, which is really cool. That's one of the main reasons why I continue to use the web platform even today. And you can see how it does that there. Okay, so that's why you adjust positions, is to keep your delta relatively static, and that's my goal here. I'm not trying to pick positions, and just because the Qs made a strong down move, I'm not going to try to pick the direction and say that it's going to aggressively recover. I know that it's very popular to play the contrarian card, but it just ultimately, I believe, and this is just a belief, there is a lot of randomness that goes in, which is why using statistics is the way to go for me. It simplifies things, it breaks it down to the numbers, and through small, consistent, persistent efforts over time, you're able to profit. Okay, so that's why you trade, or why you adjust. So now why did I go from 179 down to 171? So my process, and I'll just give this away for free. You guys can use this to try it and see how it works for you. But I need to be mechanical, and that's why I can be happy and can come home and play with my kids even when my portfolio is not doing fantastic. So when my position was originally out here, it was somewhere around there. There was a $15 spread in between those two strike prices. And in keeping mechanical, you have to choose how you decide to chase. So the ultimate goal is to bring this guy down, right? The question is how far? Do you go down $1, or do you go down all the way to where the underlying currently is, or do you go someplace in the middle? And ultimately, I don't know if the research is fully definitive on where the best place is. I have heard that you want to move it to the new 30 delta, reestablish the original probabilities. I have heard to go ahead and aggressively move up and make it a straddle instead of the strangle, and that would be if I were to move it down to the exact same strike as where the short put was placed. And that makes sense because you get to save on the minimal commissions in making that move in case you have to continue chasing it. Going all the way down to the straddle could make sense, but I do feel there is some additional risk in doing that, because not to contradict myself, but if the position did recover from that bounce, your short straddle there would be hurting, and you would be kind of emotionally in pain because you made such an aggressive adjustment. So where do you go instead? Let me redraw this since I'm kind of getting draw happy. My perspective, my thought process is that you can go ahead and take that width, that 15 total width, and just divide it by 2. So what you have here is you have 7.5 on this side of the midpoint and 7.5 on that point of the midpoint. And my goal is simply to reduce that in half. So wherever I was, move it down to halfway. That is a repeatable process. I don't need to do a ton of analytics to kind of look at all the deltas and play a lot of scenarios, because ultimately we don't have time to do that if we are not trading full time, which if you're like me, you're not trading full time, and if you're watching this video, you're probably not trading full time, right? Let's just be honest with ourselves here. So that is my process. And so if the underlying continues to move down, then you can go ahead and close it back up to a straddle, and at that point I would probably be looking to close for a loss at my early management expiration, or my early days till expiration management target in time, or I'd be looking to roll out in time to kind of give myself more duration to let that go. So that's kind of a high level of how I do the management on rolling down defensive plays when the strikes go against you. And yeah, so the last thing I want to show in this is that how do you track what your new targets are. And I did some math here and just put it out here, where if you start out with that opening credit of $504, which is what happened for me, I can take that and divide it by 2 and say that, okay, after the initial trade, I want to set a profit target window of $252. This is half of what the original credit was. You can then also say, the reason why undefined risk trades are not that scary to me is that I still have a stop loss target. I'm still going to close it and not take undefined risk. What I do is I set a mental stop loss target of here. It's 2 times the credit of the original, how much money you make on the original opening of the trade. So by making $504 up front, I'll set my stop loss target at $1,008. So if where the current price of the combined position is trading at, if that reaches 1,008, some would say roll out in time. I'm not as much of a proponent of that. I would rather even just take my loss and reestablish that same position. I would recenter it in that next expiration period. So that's how you set your initials. But then how do you adjust your targets when you make that adjustment in the strike price? So when I move this guy down, do I still look to close when the entire spread is trading at $252 and $1,008? No. No, you don't do that, because now you're changing what you originally wanted to achieve from that trade. You're getting greedy, basically, because if you've already collected $180, you don't need to get all the way down to the mark of 252 to get that profit out of the spread. So what you can do is simply take what your original target was, or any of your original targets were, and just add on that additional credit you just received to get your new target to close the spread. So here we opened up and we set our profit targets at 252. By taking on that $180 credit, that brings our new profit target mark at $432. So just do the math. It's as easy as it looks here on this notepad, and put it into your platform as soon as you make that adjustment. Just do the math once, set up your profit target window, and unfortunately you can't set 2 working orders. You can't have a profit target working order and a stop loss target working order. So you have to kind of keep one of those in your head. And given the probability of success, I recommend make your profit target automatic, and that way you can manage your stop loss manually if it continues to go against you. All right, so I think that was enough crazy math. What I will say here is if you want to avoid having to do the mental math every single time, just go ahead and click the link in the description and you can download my free trade journal. It's a Google sheet. It's very simple to use, and you're able to put your credits in as you go, as well as any little comments or any thought process you have along the way, and it'll be able to track your notional value. It'll be able to track what your target should be at that point in time, even as you're adding in how much rolling credit you've accrued throughout the duration of that position. So with that, I will go ahead and say thank you for checking in and signing in. Go ahead and click the link in the description below for your copy of the trade journal. I'll also recommend, if you'd like to see the trades that I'm making real time, I'm starting to broadcast out my activity during the trading day, and that's simply to help the conversation move forward, help you become a better trader, as well as help myself be more accountable and transparent in what I'm doing. So if you want to be a part of that, go ahead and click on that link as well in the description. I'll try to pop it up in the corner, I think, over there. And that's it. So just sign up and we'll chat throughout the day. So I appreciate you guys. Have a great evening and happy trading.